I'm Jackson Blau, Head of Community Management at Infineo, and you're tuning into our cash management with whole life insurance spaces. This week, we're talking about the secret companies use to grow massive balance sheets, and I'm not going to spoil the secret myself. I'm going to let our guests and panelists do that for you. It obviously has to do with cash management with whole life insurance, but there's a type of whole life insurance specifically that corporations can use that is really, really great as a balance sheet asset. And so on that note, I'd love Dr. Murphy, Wayne, James, for you guys to just give a quick intro for the audience and for people who may be listening for the first time. And yeah, that'd be great. Dr. Murphy, if you want to kick it off.
Sure thing. So thanks everybody for tuning in, or those who are hearing this as a recording. So yeah, real briefly here, and I'll defer to the people who are actually in production and work with business owners to set these types of policies up. But real big picture is we're talking about life insurance as an asset class. And, you might be familiar with a term policy where you have a $1 million death benefit in place for 20 years. You make your premium payments. If you happen to die in that 20-year span, your beneficiaries get $1 million. If not, you go your merry way. And, it's not like you have some kind of property or claim or equity in the thing you've been funding for 20 years. In contrast, a whole life insurance policy, as the name suggests, is in place for your whole life. And so, as long as you keep making the premium payments, at some point, your beneficiaries that you name are going to get, the death benefit or your estate. That's what you put down. And so there's interesting properties of this thing, like as an economist looking at this, that as time passes, and especially as you make premium payments, the so-called cash surrender value of this thing grows, meaning if you decide to just opt out, the life insurance company gives you a spot payment to walk away. And on top of that, they will and this is all contractually built into the original thing you sign, policy you sign, that the carrier will give you loans with your cash surrender value serving as the underlying collateral. So they don't run your credit check. They don't check your income. They don't care what your credit, what your credit score is. They don't care what you're going to do with the money. They don't have a specified payback plan. So you are borrowing from them. They charge you an interest rate, but it's a very attractive rate because from the carrier's perspective, the collateral on that underlying loan is the safest thing possible because they themselves are guaranteeing it. You literally could not default on that loan if you wanted to because they know they're getting paid back. They just don't know when. And just so you understand how that works, when you die, let's say technically your death benefit was supposed to be $1 million. If you had an outstanding $200,000 policy loan, then your beneficiaries only get the net $800,000. The carrier pays itself the loan back. Or if you surrender the policy and you had a cash surrender value of $250,000, you only get the $50,000 in cash, and they pay themselves back the $200,000 outstanding loan. So that's how it works. So it's an excellent cash management vehicle. There's all kinds of good tax implications that I won't get into right now, but that's the basic idea. And so households can use it, but also business owners. So I'll stop at this point just so I painted a picture of what the heck are we talking about. And then again, I'll defer to our experts who are in the business daily of setting clients up with these types of policies.
Beautiful. Thank you for that, Dr. Murphy. And with that, it'd be great, Wayne and James, if you guys could introduce yourselves and give a little more background on what fascinates you about cash management with whole life insurance, specifically as it relates to companies. And so, we'll dive into our conversation after this. Wayne, would you like to kick us off? Or James?
Yeah, thanks, Jackson. So it's really, what fascinates me is the fact that I'm an old guy and I've never been really properly educated on cash flow and the value of capital and the opportunity to leverage uninterrupted compounding on my money. And so I've discovered that this is one of the most significant opportunities to grow real wealth and have it transfer to future generations. And we have to think long term and we have to be disciplined, but we're already spending the money. We're already operating. We just need to learn how to do it more efficiently and effectively and allow that wealth to stay within our own ownership and control. And so that's what fascinates me about the process we're talking about today.
Thanks, Wayne. And could you potentially just share your role at Infineo as well?
Yeah, so I'm a senior agent with Infineo. I've been in this business since about 1987. and more passionate today than I've ever been about what we're doing.
Beautiful. Thank you for that, Wayne. And with that, James.
Yeah, thanks, Jackson. So I'm the director of product development here at Infineo. Basically, I drum up ideas on how to implement cash management whole life, the product, the process known as infinite banking, and build out fully developed solutions to solve particular problems for clients. And a lot of those solutions end up tackling far more than one problem, whether it be personal debts, corporate debts. It can all roll in. And so I've been doing this. So I started in this industry in 1998, and it's sneaking up a long time. And but it was just humdrum insurance business until I discovered this process. And now that was only in 2018, and I quickly became an authorized practitioner of this process. I've implemented it in my life ever since at a pretty heavy degree. I've owned many, many businesses, which would have all done a lot better had I known this at that time. But using whole life insurance inside of a corporation has many, many advantages, as we'll delve into in the next hour.
Beautiful, James, and thank you for that. And as he started to get into there, I think it's time for us to unveil the secret, guys. And I don't know if we want me to be the one to do it, but James just mentioned cash management with whole life insurance for businesses. And so that is specifically what our space is going to be about today, about implementing this process for businesses using corporate-owned life insurance and the power of doing that. And so with that, I think this is a good time to jump into our conversation. Honestly, I think it'd be great to kind of hear our experts speak on your guys' experience using corporate-owned life insurance. Like, how long have you guys seen people using this for? I mean, I know personally, I'm looking at a report right now. It's been a 9-figure industry, tens of billions of dollars for years at this point, and is just going to continue to grow at a substantial rate, especially in North America. And so with that, guys, how long have you guys seen people using corporate-owned life insurance, and how long have you been helping people use it, and what are the benefits that these people have seen?
If I could just jump in real fast, so that this is Bob Murphy talking to the economist. So just to give some flavor to what Jackson was saying there, to me, I just had a funny thing that's relevant to this conversation about 2 months ago. So people may know Dave Ramsey is just infamously against the kind of stuff we're talking about. And some guy called into his show to try to explain to him the virtues. No, I set up a policy like this, and Ramsey, just lecturing the guy and calling him an idiot and everything. And then near the end, the guy sort of in desperation said, I mean, banks do this, so how stupid could it be? And he goes, no, they absolutely do not. Banks do not use whole life insurance. And it's literally an asset. It's called, COLI, BOLI is what we're talking about, COLI for corporate-owned life insurance and BOLI, bank-owned life insurance. Like, it's literally the name of a type of asset class because it's so prevalent in this space. So again, just if you're new to this is what I'm saying, that this is such a familiar thing to say COLI or BOLI, and one last part of it is it's permanent life insurance is the general class. Then we here at Infineo focus on whole life, which is one element of that. But any event, I'll turn it over to our experts who set people up with these things. But again, I just want to stress this isn't some weird niche thing we're doing. This is so standard that it actually has its own name.
I think it's interesting that in history, Ray Kroc is accredited with having used this very strategy. In Canada, Jimmy Pattison, one of our wealthiest, most philanthropic individuals alive, used this early in his. So long before I started walking, these guys had already practiced this. But in my own journey, it took me a while to understand and figure it out. But I'm watching some of my corporate clients thrive on this, and they just are so excited about this. This is a second business for them, not just their core business, but this actual cash flow management using whole life or banking philosophy allows them to do all kinds of things. So, I've been personally involved and completely committed for about 10 years, but this has been around a long, long time and been used very successfully.
I completely agree. James, do you have anything to add there?
I can, yes, I'll go into some actual examples. as we go through this, or I can give you a few right now. What do you think, Jackson?
I think that would be great. I mean, one of my favorite examples is the Rockefeller waterfall method. And so at some point, one of you guys could potentially speak to that. That'd be super interesting. A lot of people aren't familiar that this has been a generational wealth transfer tool for years for high net worth individuals and corporations. And so, James, if you want to dive into some examples, I think that could be helpful for our listeners here.
Sure. I can address what you just brought up on the Rockefeller method. I know Gary Gunderson wrote a great book, what would the Rockefellers do, talking about this very specific thing, and going back more than 100 years now, that family within their family office that manages everybody's money, obviously they're an extreme example of wealth, or certainly they were at that time. But every child born into that family and the extended family, even to this day, not a fully funded, but a corporate policy is taken out on that child within the family trust, and that money sits and grows. Now, what happens is every generation that passes away, all those death benefits end up back in the family office, in the family trust. So anytime any member of that family throughout life, anytime they need to purchase anything, start a business, do any type of financing, they go back to the family to get the money. They pay the interest back to the family. There's always people in the family that do better than others. Sometimes those loans don't get paid back. Sometimes businesses don't work out. But does the family lose any money? No, because the death benefit on that person would clear off those debts in the end, making the family even more wealthy. And this just trickles from generation to generation to generation. No dollars ever leak outside the family. And ultimately, on a smaller scale, that's what we're trying to do for our clients. It takes some time to, what I have to say, put an aquarium around the family's money so there's no leakage. So they stop paying interest at third parties, and more importantly, they stop losing the growth on future dollars that they're actually spending today. So I'll just give you a couple examples of clients, and Wayne's going to dive into one of these, I think, probably a little bit more, but I'll just mention, if you look at a lot of the big farms, and farms tend to be getting bigger and bigger, and there's fewer and fewer of them for a lot of economic reasons. But these farms, especially cash crop farms, operate massive operating lines of credit where they borrow a ton of money in the spring and throughout the year. They hopefully pay it all back in the fall and have some left over. Now, if those farmers would take some of that profit at the end of the year and start moving it into one of these structures and then borrow against it, each year they'd be able to take over more and more of their operating line. And now it might take them 5 years, it might take them 10 years, but I'd say those years are going to go by in any case. But if they went even 10 years out and were able to take over the entirety of their operating line of credit with their own personal banking system run through their whole life insurance contracts or policies, and I mean multiple policies at this point, then all those dollars of interest are typically paid to the bank in that operating line every year, no longer flowing to the bank or staying within the family, and they will from that point as long as that family is in that business. And many of those farms roll over generation upon generation. The second thing I see come up a lot is equipment dealers. A lot of equipment dealers, whether selling farm equipment or construction equipment or vehicles, they get floor plans provided by the actual manufacturer. And what I mean by floor plan is that basically it's an operating line saying we're going to give you 15 tractors this month and you can pay interest only on them or no interest at all, but for the next 6 months or 9 months. And if you haven't sold them by then you have to buy them out. Okay, so there's pros and cons to that depending on how the market's going. Same thing, if those dealers were allowed to take over bit by bit that operating line, then not having to use the dealer's floor plan, all those restrictions will be lifted off them. The pressure comes off on the business and how quickly equipment or other products need to move off the lot. And again, the interest will be accumulating to their benefit and not to a third party. And the last small one, and maybe I'm just rambling here too much, the last small I'll bring out is just a regular service business that has the typical cost of sales, whether it be salaries and benefits, purchases of small inventory. Again, all those things knock down your revenue down to your gross profit. But if all of those things, again, could be financed through an internal structure, your own family bank or your own corporate banking system built upon whole life insurance, then all the interest lost in those dollars does not need to be lost. So if you bring that back to the personal level for a second, most people make money They spend most of it. If they have any dollars left, they try and save it and earn some type of return on what's left. And what we're talking about is the ability over a number of years to be able to earn a tax-free compounded rate of return on the entirety of what you spend, not just the dollars left over, and do that on a no-risk basis. So I'll stop there. That's a lot of material.
I think that was great, James. And there are a lot of things that we can talk about from here. Dr. Murphy or Wayne, did you have anything to add before I ask the follow-up question?
No, I think you should go right ahead and do it.
Okay, perfect. So I was honestly just curious. You mentioned farms or businesses that do equipment financing, but is there really one business that you see benefits more than others, or is this a solution that can really work for any and all businesses? Do you have to be a certain size, or like, I love if you guys could speak to what sort of businesses and companies can actually utilize a strategy like cash management with corporate-owned life insurance.
So I'll jump in first just to mention. So with all this stuff, it makes so much sense for everybody to be incorporating this, even if you're just a salaried employee. So we don't want to be making it sound as if there's all this. If you fit these 5 criteria, you might want to look into this because maybe it makes sense for you. That's not what we're saying. But what I am saying is it makes particular sense. It's like a no-brainer, if you will, if you're a business owner that's very seasonal, especially if you're relying on like a conventional bank line of credit in order for you to, you have down months where you're negative cash flow, so you're drawn on your bank line of credit, and then you make it up on busy months of the year, kind of thing. And that the whole cycle works out, and you make a profit for the year. But if you're in that kind of a situation, or if you have periodic large scale investments where you're borrowing money from outsiders to replace an oven if you're a bakery, or replace a tractor, or what have you if you're a farmer, those are the kinds of things where if you're regularly dependent on outside lenders, this is really what you want to look into, particularly if you share my views that the economies in the U.S. and Canada are not on a good trajectory, and that we might be in store for some rocky roads ahead. You don't want your whole business to be dependent on the good graces of the credit markets, being fully functional and so forth. That you don't want to be that vulnerable.
If I can just add something here, this is a fundamental principle that if you're a living, breathing human being, this should be considered as part of your wealth building strategy. Whether you're a business, an individual, an infant, this is a fundamental principle that is worth your energy and effort to learn and understand and practice, because it will allow you to grow real wealth and be able to transfer it. So maybe that's overstated, too simple. Certainly works for businesses because of the amount of cash flow that they require to operate, but it is a fundamental principle that is worth understanding.
I completely agree there, Wayne. James, what you want to add something?
Yeah. So just to answer your question a little bit, on is there a spot that it works best for? The answer is no. I mean, it works great for everybody, but I'll give you 2 examples where we run into it. So number one, if somebody is using a big operating line throughout the year, being able to take that over in-house and not have to follow anybody else's rules or timetables or minimum payments, that's pretty easy for people to understand as we do it. Where it takes a little more nuanced explanation is the seasoned businesses that are operating entirely on cash, right? Who, give an example, they have $1 million in revenue. They have enough money laying around so they can pay their $750,000 of expenses as they go throughout the year, and they have their money left over at the end. Profitable year over year, but what they don't realize is the loss of all future growth in this example on that $750,000 a year that they're spending directly on the operations of that business. If they could earn a return on the whole 750 instead of just the dollars they have left over without taking any risk, simply by adding a step in the process, it makes a dramatic difference. But it's cash spenders, cash buyers, they need a little more explanation to see how much they're actually giving up and losing. And those dollars tend to be far higher than the interest paid by using somebody else's money in the long term.
That's great, James. And so we've talked a lot about kind of the process, cash management with whole life insurance. We've dove into a little bit about who this can work for, but we didn't really talk much about the actual product itself. And I know we at infineo really believe that the product is important and that's the foundation of this, but the magic happens in the process, in the solution. And so if you guys could, just potentially for our listeners who may not be as familiar with corporate-owned life insurance, speak to the sorts of products that we're talking about working with here, potentially key man insurance and potential products like that. If you guys could speak to the types of permanent insurance that we use in these strategies.
Sure, I'll take a first crack at it just to give the textbook theory, as it were, and then let our producers actually dive into some anecdotes, perhaps, about what they actually did in real world cases. So the big picture, like we say, corporate owned life insurance means what it suggests, and typically what you're going to do. The reason corporations like this is, for example, they can do something like what's called key man insurance. So they'll take out a policy. You've got some executive who works for your firm, and wow, that would really be devastating if the guy gets, in a car accident. Like, oh wow, he's the vice president of marketing, and that would really hurt our company if this, besides us feeling bad, and we know the guy's family, whatever. But besides those personal, emotional reasons, geez, if we had to hire somebody else, it would take us 3 months to get back on our feet. And so you need to demonstrate with all this stuff. It's life insurance. You have to have an insurable interest. You have to show the carrier when you're applying for the policy that, yes, it would be to our detriment if this person were to die suddenly. And so that's one way you can demonstrate to the carrier insurable interest because, hey, this guy's a key person in our company. So there, again, it's not that key man is a separate type of policy for, these are all similar product designs, but in terms of what economic function is it serving? Oh, it's key man insurance, that kind of thing. And within a lot of these things too, you can get it through underwriting very quickly, depending on how much salary the person has. So that's partly why some of these things, would be relevant to the business owner, just in terms of how fast could we get this up and running. But the idea is, you get policies like why would they want to do that? Well, because besides just having the basic death benefit coverage in force, now that's an asset that's on the company's balance sheet that's, growing. And these things just, as economists, I can tell you they're very safe, right? Like the default risk is quite low because the life insurance companies, they're not trying to impress shareholders with their quarterly returns. Life insurance is very conservative and boring. They want their clients to know the death benefit will be paid if I happen to die. They're not trying to make money on life insurance. They want that coverage in place. Just like if you have car insurance or fire insurance, that's what function it's serving. So it's very dependable. But having said that, the returns still are there, especially if you take into account the tax treatment. And so this is a nice thing to have on your books, and it's a source of liquidity. You say if the company all of a sudden needs an infusion of cash, if they have gone through the process of taking out all kinds of key person life insurance and all their executives and so forth, they can go and ask their CPA or their chief financial officer, how much in cash value do we have on our COLI policies? And he goes, oh, we got $3 million right now. So they can get it the next business day. Because again, the life insurance carrier doesn't have to go and evaluate the merits of the loan or whatever. They know the person's good for it because they guarantee the collateral. So that's the kind of thing we're talking about here, that when you realize how these things work in practice, it's very robust. It's like a Swiss Army knife in terms of all the different things it can do for you. And so everybody should integrate these policies into their framework.
I think if I can add to that, Nelson Nash used to say this, money must reside somewhere. And so when you have a cash balance in a checking account, a corporate account, basically it's not doing anything for you. And every time you touch it, you kill your compounding. You interrupt your compounding, and then you interrupt that for the rest of your life. If you simply took that $100,000 in your checking account and transferred it inside one of these properly structured participating dividend-paying whole life insurance policies, which incidentally is a 180-degree shift in the way we basically think at present, we would now have $100,000 sitting inside a structure we own and control, and we can actually access that anytime, as Dr. Murphy just pointed out, without interrupting our compounding. And that's part of what people don't understand readily, is it's the uninterrupted compounding of our capital while we're actually leveraging it and using it and growing our business and our asset that is so profound, and yet not everybody sees it readily or quickly. And it's a really important aspect of what we're wanting to do and why we use these properly structured policies.
The only thing I would add to this piece is if people who are using the bank's money and operating their business, they know firsthand how much pain in the butt, frankly, it is to constantly have to go in and do financial reviews and check your balance sheets and check your ratios and provide personal guarantees on top of your corporation, which often happens again and again and again multiple times a year in order to keep an operating line open. And all of that goes away because when you borrow from the insurance company secured by your own policy, and again, as Wayne said, the lender, in this case, the insurance company, guarantees the loan because they guarantee the collateral is going to grow behind the loan. So unstructured policies, unpolicy loans, no questions, no qualifications, no fixed payback schedule. It's completely under your control.
And stating the obvious, many people, when they hear this, they go, well, this just sounds too good to be true. I mean, it doesn't even sound right or legal. The reality is it's been around and available to us for over 175 years. The fact we're ignorant of how it works isn't anybody's fault, but really our own. And so take responsibility, do some productive things, make some difficult choices. That's again, just a fundamental way of our thinking. This is what we invite our clients to do every day.
Perfect. That was really, really helpful, guys. And on that note, it would be really helpful if we started talking about it a little there, but I'd love if we could dive more specifically into the benefits of incorporating the strategy. We've talked about the liquidity through policy loans and the benefits through lines of credits or having to go and get a loan from a bank. We've also hinted at the tax advantages of utilizing this strategy. And so, Wayne and James and potentially Dr. Murphy, I'd love if you guys could potentially really explain what goes on with the liquidity and tax advantage aspects of implementing this strategy and what is really going on under the hood here that allows us to achieve these benefits.
Okay, sure. So I'll be real brief here, just again to give the big picture on some of the stuff. Hey, with this, let's do our standard disclaimer. We're not tax attorneys, and so if you were going to do this in your own practice, you'd want to consult with people to make sure you know the relevant things here. But big picture, and there are different rules in terms of corporate owned versus household owned. But in terms of just appealing to the average person, what does this do? Part of what goes on is, for one thing, the death benefit payment is income tax free to the recipient. Okay, and these aren't loopholes. That's what I want to stress here. It's not like the life insurance lobby went to Washington and got all these these special things put in place. It makes economic sense, right? Because it's insurance. It's compensating you for a loss, right? So if you had a $30,000 car that gets totaled, and then your car insurance company sends you a check for $30,000, that's not taxable income. That's just making you whole from your loss. And so likewise, if you have an insurable interest in someone and they die, that check, the death benefit check, is not taxable income. It's just compensating you for the loss, even though if it's like your child or something, it's not. It's an emotional bond. But again, it's the same principle. Also, again, in here the stuff gets complicated depending if it's corporate and whatever. But the growth of these policies, if it's handled properly, is often there's not tax liability from the internal growth. And that's one of the reasons that even though the carriers, as I said a moment ago, are very conservative and they're investing in fixed income securities, highly rated corporate bonds, things like that, once you take into account the tax considerations, they're actually quite decent returns, especially if you hang on to these policies for the long run. And again, even there, though, it's a similar principle. It's because these things are life insurance. And so that's also why. And then the last thing is, the policy loans are not taxable income, again, subject to caveats that, we don't need to get into right now. And there, again, the reason is straightforward. Why, if it's a loan, it's not taxable. Just like if you put something on your credit card, you go buy a $1,000 system or something from Best Buy, and you put it on your credit card. Technically, you're borrowing $1,000 from Visa, and then that's how you're paying Best Buy. That $1,000 isn't, you're not going to get taxed on that as income. No, you're borrowing the money. So likewise, if you're using these policies as a source of liquidity in order to manage cash flows, the money coming in the door is not taxable. So that's just, some of the ideas here, just to show if you handle these things properly, not only do they serve as an excellent cash flow management vehicle and you get some decent growth, it's not typically going to hurt you tax-wise. And again, these aren't weird loopholes. It just follows if you think through the economics of what's actually happening. The money coming in the door is not net income in a financial sense.
Maybe just a quick story to emphasize what Dr. Murphy just alluded to. But a few weeks ago, James and I did a seminar with a group of high net worth farmers, and one of those farmers had the foresight to invite his accountant to that seminar, unbeknownst to us. So as we walk in, we realize there's an accountant sitting in the room that is curious about what we're doing. And so as we unpack the information and share the content, he became completely enamored. He said, I can't even believe this is available to us and to every farmer. And so he had a number of questions, and later he went back and he went through the Income Tax Act, and long story short, he's now joined our team as on a retainer to be there to speak to the Revenue Canada pieces, not to try to talk about the product or the process as much as simply verifying that it is in the Income Tax Act and that it is legitimate and that exactly as we're explaining it, it works. And anytime we get a little close to an edge, he might just point out, a caveat, as Bob said. But I thought it was so intriguing that an accountant so quickly grasped this and then went back and did the hard work of checking the act to come back and say, I am all in. Every one of my farm clients needs to know about this particular product. So any one of my business clients really needs to know about what's available to them and how this can advantage them and ultimately benefit their business and grow their wealth and allow them to have something very powerfully significant to transfer to the next generation.
Yeah, I like to try and give specific examples on things. And, we're talking about maybe some of the tax efficiencies of doing this. I'm going to come at that from a different angle. And, let's say you have a corporation that makes $100,000 or pays $100,000 in income tax a year. I'll just keep easy, flat numbers for this example. If that money was already stored inside of one of these policies, rather than paying it directly, because if you paid it directly, even that one single year, if we're talking about an internal rate of return on these policies, and Dr. Murphy can speak to this, but if I say between 4 and 5% over the long run, and what that means over the long run is as they recalculate the return on those policies each year, that's retroactive to day one. So overall, that's what we can say on the long run. That's how that's going to work. So on $100,000 of income tax paid, even in 1 year, if that money was left alone inside of a policy, earning 4 to 5%, let's call it 4.5%, that over a 40-year span, that $100,000 of tax would have grown to more than $600,000. But because you spent it directly to pay that income tax, you actually lost about $500,000 of growth over a 40-year period. Okay? Now, on the other hand, if that money was in your policy, then that's $500,000 of growth you would receive on that money. Now, you're still borrowing from the insurance company and paying it back. And if we call a policy loan interest rate of 5% each year, you borrow the money out, you pay your income tax, and over the next 12 months, while you're saving to pay next year's income tax, you're simply paying back that policy loan. And at 5% interest on the loan, because it's a declining balance throughout the year, you only pay about $2,700 or about 2.73% on a declining balance throughout the year. So it costs you $2,729 a year. So if you simply had the exact same size business and every year you paid $100,000 in income tax in that example, you would pay a little over $109,000 in interest to the insurance company over a 40-year period, and your account will return back to you more than $500,000 in growth. Simply by adding that step in the process, you made over $400,000 within your account, or I should say saved, or not gave it, you didn't give it away by paying $100,000 in cash and income tax, because along with that 100 went every dollar it could have earned for you had you kept it. This allows you to keep all those dollars of future growth on that just one specific example, that one expense.
Wow. That's incredible, James. On that note, if anyone has any questions about anything we're talking about here, we have a pinned tweet up, and we encourage you to put a question below it, and I will make sure and get that to our panelists. And with that, we actually have Liz Lamond joining us. Thank you for joining, Liz. And on that note as well, I wanted to move into a little bit of a different topic here that we haven't mentioned yet. So we've talked about the liquidity of these corporate-owned life insurance policies as it refers to the policy loan aspect. You have this cash value that has the guaranteed growth rate that you always have available access to take a loan out against. But what we haven't talked about is what people can do with these policies if they need the entire the value of them now by either surrendering or selling their policies. And so it'd be great if you guys could potentially speak to the benefit that is just the underlying cash surrender value and what people are able to do in terms of selling their policies on secondary markets.
Okay, sure. Yeah, I'll take a crack. So again, the term cash surrender value means what it suggests, that if you surrender the policy, if you decide, yeah, I want out, that's the amount they give you, and that grows over time. Also, that's partly why the policies seem to perform better, to speak loosely, over time, because strictly speaking, from the insurance carrier's point of view, what the quote pure insurance charge they have to assess, either literally in the case of some types of policies, or in the case of whole life, just kind of originally when they figure out the premiums they got to charge, and the actuaries run the numbers. As the cash surrender value grows over time, and the death benefit is what is the gap is what's called the value at risk. So like if you have $1 million death benefit and the cash value has grown to $300,000, there's really only $700,000 of pure mortality risk at play, and so the amount that your premium payments have to cover for that thing goes down over time. So that's also why the rate of growth on these things grows as you hold them longer. But that's just an aside. So as Jackson said, yeah, at any time, if you wanted to, you could surrender these things. Also, you could take them to outside lenders as well. That other institutions are growing and recognizing the value of these things as just assets, collateralizable assets. And so even if you wanted to keep the policy, you don't necessarily have to borrow from the carrier. You could pledge it as collateral to other lenders, especially if you had a bunch of these policies. Like instead of having to make individual requests on each of 50 COLI policies you might manage if you're a big company with lots of employees. Instead, maybe you could just work with some outside institution, and the whole block is kind of sitting there as a pool, and you could manage cash flows that way. So those things are all up and running. Beyond that, though, part of what we're doing at Infineo is trying to foster the creation of a more robust secondary market. So right now, like the legal and regulatory infrastructure, at least in the United States, is in place for that. But right now, it's more typical if like somebody develops a cancer or something, or a brain tumor, and they want to sell their policy to somebody else, they'll come in, and that's what's called life settlement. And you can get multiples of the cash surrender value there because people recognize the arbitrage that, oh yeah, we just keep this policy in force. This guy's life expectancy is a lot lower now than when the policy was issued. So there's a mismatch. But that's not what we're doing. We're talking about just viewing it as a cash vehicle. And so even though, like you say, in principle, all the regulatory and legal structure is there, there's not much of a secondary market up and running right now, but that's what we at Infineo are aiming to expand. And so the vision is that yes, people with these policies could sell them to somebody else. And that's another way. And, just to give an idea of what would the economics of why would that make sense, there could be somebody in a different country whose currency is very volatile. And to that person, to have an asset that's U.S. dollar denominated and grows at a steady 4 to 5% over the next 20 years, that person might, wow, that would be amazing. I'd love to get my hands on that. And they might value that more than what the nominal cash surrender value is. So if there was a way that we could facilitate that transfer, there's a lot of economic value added for everybody walks away happier. So that's the kind of thing that at Infineo we're building the infrastructure to be able to do that digitally and so forth. But that's this is the side.
Wayne, James, or Liz, do you guys have anything to add on the potential for a secondary market for COLI policies?
I don't think I can add anything to what Bob already said.
That makes sense. And that was exactly what I was looking for. Dr. Murphy, thank you for adding that color there. Like we said at Infineo, that's something we're really trying to build out. The life settlement rails do exist and are utilized. It's a multi-billion-dollar industry right now. But as Dr. Murphy mentioned, it's really only for people with high mortality risk right now. And we believe that we can create, and we believe and know that we can create economic value by making a more robust marketplace. And so with that, it would be great if we could speak potentially about some more real world applications of corporate owned life insurance and potentially some case studies, if you guys have any readily available or just top of mind that you could speak about of people that you've worked with that have utilized COLI. We've spoken already about the high net worth farmers. And so if we could try to potentially speak about some other case studies, that'd be great.
Yeah, I'll jump in. I think one of the things that I often talk to business owners about in specific is how do we make sure that you're extracting value from cash flow that's already going through your business anyway. So I'll give you an example of there's a lot of businesses out there who have large supplies that, costs every month of money sort of running through. They may have equipment that they're financing in some way. They may have, significant tax expenses or other sort of product expenses, equipment repairs. There's always, employee payroll. There's always a volume of dollars that are flowing through every single company. So what we're really doing with our strategies with Whole Life is really looking at the best way to allocate assets. And that's really the key. So how can we allocate those assets more strategically such that the business owner can not only have protection should something happen to him or one of the key people in the business, but also so that the business is like growing wealth and benefiting by using this product. So we when we're looking as well as exit plans around the business, however the business want to exit from, we want to make sure that there's an asset that's being developed. So we have women and men who have been growing their business over a long period of time, and you can't be sure exactly what sort of price you're going to get from that business. But if you've been able to allocate assets sufficiently throughout the time of the business and get benefit from that, then you can have, a significant asset that's grown and is very, very effective. So another thing that we look at with people as well is many businesses want to expand. So I have a few business owners right now that I'm working with who they're looking to how can they leverage and use their whole life policies to expand their business into more operations. So lots of really powerful applications such that the business owner is really benefiting from what's going through as well as having that level of protection. So the thing that I really enjoy about working with business owners in this is it's very customizable. So we can do this for, any sort of any amounts of cash flow. So I think there's often a misconception that you have to have a certain amount of cash flow or be at a certain, level in your business for this to make sense. But, we speak with a range of business owners who are at different stages in their business, as well as different levels of cash flow. So, the customizable piece of it is very, very powerful.
A 100%, Liz, and I definitely agree. And so on that note, Wayne, Liz, James, do you guys have any other potentially compelling, interesting stories about specific clients you've worked with? Obviously not going and saying their names or the name of the company, but with just high level kind of explaining what we were able to accomplish by implementing these sort of strategies with clients.
I may be jumping the gun here a bit, but, problems require solutions. And what we're always looking at is what problem are we trying to actually find and put a solution to? One of the things that often people don't necessarily realize readily is that this strategy also provides a succession plan that is remarkably fair. And it also allows the principal owners to be able to allow the business to continue without having to sell off assets to help them retire or begin to slow down. And so just the features that are inside these structures, if you can get your capital transition from a lender or bank institution inside one of these vehicles, you have opened up just a wealth of opportunity for options and how you can solve various problems facing your business.
Yeah, I would add to that a lot of business owners that we sit and talk to, at not even just business owners, but the fact is you don't know what you don't know. And oftentimes we spend a lot of the time actually pointing out what the problems are where they may have thought they had none. And they might have a very successful operation or happy with their current profitability. But if we stand back 1,000 feet and have a look at it and show them a different way to run the numbers through their business, they realize how much better it could have been. And then they get a little miffed, honestly. And we hear every week, I wish I'd have known this 10 or 20 years ago. And yeah, we all did, I suppose. But you can only start where you're at. And ultimately, especially if it's a generational business, like farming is, for example, Wayne speaks about, then this can be the last generation, the last decade that you're never ever using the bank for any part of your operations. And I mean, that's people almost get uncomfortable with the fact that there's a better way to do it. We even hear people say, you know what, I don't know how to operate without debt. This is how I've always done it. And it never occurred to them until we pointed out there's a way to do that without needing a third-party debt, third-party interest payments, third-party reporting. It's a much less stressful way to operate your business once they get over the small learning curve, but it's not that big because they see real numbers and real examples. And when we're implementing these strategies, we're not using, like I like to say, we're not using hope and luck. The products come with guarantees. This is simply how it works.
I think to add to that, and I am not just here to be a critic of banks, but I often say this to clients. Banks don't actually take risk. Banks lend money to people that are sound, solid, and capable of cash flowing their loans. They do not lend money to people that are in jeopardy or even in potential question of that ability. And so when you need money, that is not a good time to go and try to get it. You can get money anytime when you don't need it, or you can get it anytime your financial position warrants it. The lenders will lend you money. Many people in business know how difficult it is to deal with difficult financial times or economies. Getting your capital put inside a structure that you own and control, that you have unbridled access to, that you can get a hold of whenever the time is necessary, without any paperwork, without any justification, without any financials, without any ability to show that you are sound and solid. You can get access to that capital, cash flow it, and James mentioned this, in an unstructured repayment you have to have discipline, and you have to actually have good coaches that can help you make wise, informed choice. But powerfully profound when you can finally get a pool of capital that will actually cash flow your operations and eliminate the bank. Now you're using the bank for your benefits, not being used by the bank for theirs.
If I could just jump in, sort of going more along with what James was saying there. In my experience, when I explain this stuff to people, that there's two types of, besides just people saying, wow, that sounds too good to be true or whatever, or, what is there a loophole? What's going on here? Besides that sort of thing. But the two main things that I get, it's just ironic because they cancel each other out, is one type of person will be like, if they're younger, they'll be like, oh, yeah, that would totally make sense if I were older and had a bunch of assets that I could move up. But right now, I'm just in my 20s and, I just got my first real job, so it doesn't make sense for me. And then likewise, some older people will say, oh, yeah, I wish you had told me this 20 years ago back when I was younger and I had and was working in my prime, but now I'm sort of semi-retired and I've just got a bunch of assets I'm living off of. So it's not so the point being, no, I mean, the strategies, the particulars are different depending on the type of client, but this makes sense. Like what, as Nelson Nash was, when do you want to take control of the banking function in your life? Right away, right? It's always a good time to do that. But again, I'm adding the extra flair of, I do not think the U.S. and Canadian economies are in a good spot right now. And so this is just extra urgency involved as to why, if this, if what we're saying is making sense to you, I would really encourage you to reach out to one of our agents at infineo, and they can just kind of show you with your numbers, this is what it would look like.
And on that note, I've actually pinned a tweet where if this does interest you, if what we're saying resonates with you, and you think you can implement this on an individual or a company level, we highly encourage you to book a call, and we will help you get started in any capacity you need. So as I said, that first pinned tweet, you can click the link depending if you're in Canada or the US. We'll match you with the right person regardless. And so, yeah, we definitely encourage you to do that. It's a no cost, no commitment consultation. So, yeah, with that, we have about 8 minutes left here. And I'd love
Can I just jump in, Jackson, before you jump to
Yeah, of course, Liz. Yeah.
I just wanted to add to that. Like, I would say that, like, the thing that's very rare about what we do is, I'd say 100% of the times when, like, not 80%, but 100% of the times when we talk to business owners, they will say, I wish I knew about this sooner. And the thing about that is, I know others have said that, but the thing is that business owners are working really hard and are very, very busy to make their businesses roll, efficiently, to capture profit, to do all the things that they're trying to do in their business. And so I think sometimes it's hard to take the time to do things differently, but if it would, the thing just to kind of provoke some thought is, if you could change what you could achieve in your business over the next 5 years, would it be worth some of your time to find out a little bit more about this? So it's not complicated. And the thing that's very powerful, and I think speaks to business owners, is we can just show you the numbers in terms of how this makes sense for your business and how it would work. So, we spoke to the customizable piece of it. That's why we need to, have a conversation with you about how it would work specifically for you. But I think, taking that time to just see if it was a fit, and it may not be a fit for every business, but to see whether it's a fit for your business and if it could achieve a different result in that time, is just something to consider in terms of where you want to be in terms of your business and protecting your family over that period of time. So I just kind of wanted to add that in. Thanks, Jackson.
No, thank you, Liz. I did not mean to jump the gun there. I really, really appreciate it. And so besides booking their personalized consultation where they can run the numbers with you guys and see how this would look for their life or business, what other first steps would you advise taking to someone that's listening to this and is interested in learning more about how they can get started? Is there a book, a podcast, a person that you would suggest that these people get familiar with? Is it Infineo?
Yeah, I'm going to suggest that they jump on our Infineo website and have a look at some of the articles that Dr. Murphy's actually written. Maybe you can speak to those a little more, Dr. Murphy, but I think that's a really good first place just to kind of get a little bit of education. They're a quick read and kind of gives you some insight into, how this works. But jump in, Dr. Murphy, you can maybe add some more flavor to that.
Right. So, if you go to infineo.ai, that's our main website, and at the top, there's different tabs and articles. You click that, and you can just scroll through it. There's all kinds of depending on what you want, and it varying degrees of from 50,000 foot view. If this is the first time you've heard about it, I explain the basics that way. Or if you want to get into the weeds and what's the rate of return on these things compared to other types of it, all kinds of stuff that if you just want to see more of the mechanics, especially if you're a numbers person and you just want to see how is this working? It seems too good to be true. We demystify it. It's not that we're relying on magic tricks here. We're just showing you when you realize what it is. On the one hand, it's kind of simple, but on the other hand, people, it's real obvious. And once it clicks with people, they're like, oh yeah, geez, why didn't somebody else tell me this? And that's what we're trying to do.
Wayne or James, any other resources that you guys would recommend people getting familiar with beyond Dr. Murphy's articles and our podcast, Not Goalie?
There's dozens and dozens of books they can look at. There's untold YouTube videos and TikTok videos. Yeah, I said that on purpose. But that being said, when they sit and go through some information with this, it's not 30 minutes or an hour, right? It's whatever time it takes. It's multiple meetings. It's a discovery process. We need to figure out how your business operates, what's happening in it. And at the end of the day, it's very rare that it happens. But if it's something you actually choose not to do, I assure you that the discovery and the educational process that you go through to do that will not be a waste of your time. The biggest frustration, as Liz pointed out, is, people start to look backwards. Man, had I known that before, things could be so much better now. Well, I don't have a time machine, and unless you do, number one, I'll use it with you, sure. But we don't have that. So all we can do is look forward and try and improve from today forward. But looking at your own numbers implemented into a plan is the best education that you can get, because it matters to you, it's relevant, and you're paying attention. You can read all kinds of books, listen to all kinds of podcasts. They're all out there. But, and I think you should do that, but none of that is going to hold a candle to actually sitting and talking with somebody and walking through the scenarios and looking at it, see how it looks in your own life and your own business.
Great. And with that, guys, we're running up against time here. Do you guys have any last thoughts to leave the listeners with before we close things out here regarding the implementation of corporate-owned life insurance and how companies have been able to use it to grow massive balance sheets, as the title of the space suggests?
Yeah, sure. So I'll mention again. So for people, if you're new to this and then you're like, okay, well, let me do some due diligence, and you go and look around, and just to forewarn you, there are people that really don't like what we're doing and are going to tell you. But one of the criticisms you'll see is, oh yeah, that works for rich people. It's like, okay, so isn't that something you want to, like that's actually a compliment to the strategy when people say that. So, that kind of thing just, again, makes me chuckle. Again, this is what we're doing. Go look it up. It's Boley and Coley, bank-owned life insurance, corporate-owned life insurance. There is a reason banks and large corporations are doing this, because it makes a lot of sense. But it's not merely for them. That the people here at Infineo can show you how it can work for your individual business, or again, even if you're just a household and you've been tuning into this because you're curious, it works for you too. The particulars are different. That's why you need to talk to someone who knows how to design these things. But the strategy is basically the same.
I'll be real quick, Liz. My first question is, did they implement this strategy once they were rich, or is this strategy what got them rich?
Yeah, I think just, our goal is education. So, we're there to educate you and support you, and then continue to work with you if it's something you want to implement, in supporting you to, implement it effectively in your business with a plan. So, yeah, just take the time to get educated. Over to you, Wayne.
Yeah, I don't know that I have anything to add to that other than, do yourself a favor and at least educate yourself and determine that this is or isn't for you, but don't just ignore it.
Well, I really, really appreciate you guys adding those last insights there, and just appreciate your guys' expertise throughout the entire space here. It's been a real pleasure having you guys on and talking about corporate-owned life insurance and the ability to manage cash with it. We hold these Twitter spaces every week. We alternate topics between cash management with whole life insurance, exploring various topics in that rabbit hole, and then also looking at another facet of our business, which is the tokenization of real world assets. And so next week we have Relio coming on, and we're going to be talking about the revolution of tokenized real estate. I've just pinned that tweet there if you'd like to set your reminder for next week's space. We highly encourage you to do that. It should be a really, really fun one. And then the next week following that, on Tuesday at 12 p.m. Eastern, just like all of them, we'll be back with our cash management with whole life insurance space. So be sure to stay tuned. The easiest way to stay up to date with all of our live events is going to be to subscribe to our newsletter. And so if you are interested in doing that, you can Google, or you can put this URL into your search bar. It's going to be infineo.ai/#newsletter. Again, infineo.ai/#newsletter. And it'll take you to the site, and all you need to do is put in your email, and you'll be informed of all of our latest live events. So again, thank you everyone for being here, and we hope to see you next week. Thanks again.